The previously invulnerable credit markets are now showing signs of cracking. It's not just risk off in stocks. Far more important, there's a risk off growing in credit too, and it's becoming more widespread. Several tiers and classes have seen prices reset, and some of them sharply. And yes, there's a hint of Japanese in all of this too. Credit spreads only a month ago, they were at their tightest the market had seen in seemingly forever. Record levels of sheer complacency. Buyers totally convinced everything was good and there was no threats on the horizon. It was buy, buy, buy at any price, no matter how little the additional return. And while that sounds like a good thing, it's not. It never has been. Once complacency gets past a certain point, this is no longer the rational analysis of risk or actual conditions. It becomes pure rationalization. And it's circular too. The market is pricing nothing bad because everything looks good, and we know everything looks good because the market is pricing nothing bad. But over the last month, however, the nothing bad has decisively shifted. Same with stocks. Credit markets are highly susceptible to the traditional recession dynamics. Only in some of these markets, the exits aren't so wide, and it can spill over that feeds into all sorts of markets like stocks and also the real economy. Plus, if we're not really careful, even the monetary system itself. And we're seeing evidence for the first part of that process, the reverse in spreads and other credit prices as the, quote, recession scare keeps coming up. And it won't go away, as we were reminded yesterday with U.S. retail sales. Credit is a big one. And there are more than a few warning signs that are piling up in the space. Some of them are even bigger than last August. And yes, as I said, there are some Japanese fingerprints on this one. But where we left off in February was ultra low credit spreads, which is counterintuitively never a good sign because it means ultra levels of complacency, and complacency that happens just before everything turns around, just before 2007 and the 2008 crisis, just before the 1998 crisis or the dot-com recession too. But why were they so low? And the reason just goes back to pure, at least economic perception. Everybody believed in the soft landing, and if you believe in the soft landing, then there's no danger to all the companies that issue loans in the credit market, or to stocks and equities for that matter too. And so credit markets, like the stock market, participants in them are looking for signs of the traditional recession, because the traditional recession, credit doesn't do well because everybody is thinking which one of these junk companies is going to go bankrupt, that's going to default on interest payments and maybe the principal as well. And so rising credit spreads, like falling stocks under these conditions, are a sign that the marketplace is taking these macroeconomic concerns very seriously. In credit, you have to, because there is an actual real world connection, whereas in stocks, not so much. So credit markets, they're all about the macroeconomy. Buy, buy, buy when everything looks good. Suddenly, when the possibility of a traditional recession goes up, everybody starts to look for the exits. That's what happened last August. But before we got to last August, everybody was on board with the soft landing. Here's what Deutsche Bank put out in May of 2024, talking about the favorable dynamics in risky credit when spreads had already been pushed really low back then. The same underlying drivers of CLO deal volume, CLO, risky credit, junk bonds, leveraged loans, are all the same thing. Tight spreads, high all-in yields, constructive loan prices. They're producing positive knock-on effects, improving market value and credit portfolio metrics, an acceleration in refi reset activity, and an uptick in deal liquidations. These in turn are further boosting investor sentiment, there it is, for the market, and ultimately driving more demand when combined with a constructive macro backdrop in which GDP remains relatively robust and unemployment relatively low amid a broadening of the investor base as U.S. domestic banks return as active buyers. So all these people are buying because GDP is positive and the unemployment rate seems to be low and the payroll reports are positive, and we don't see the signs of a traditional recession. Forget about the forget how to grow economy and that style of recession. The credit markets only care about something like 2001 or 1990 or, God forbid, 2007 and 2008. It's the more apparent and more obvious downside in the macroeconomy that has the marketplace moving to the exits. And as Deutsche Bank was pointing out, GDP looks positive, okay. Suddenly GDP negative becomes a real chance, a real possibility. That's when you start looking for the exit. Because if you see the negative GDP, you see the negative payrolls, You see the rise in the unemployment rate, it's too late. You got to get out before then. Now, before we get back to the rest of today's video, I want to tell you about today's video sponsor. We talk all the time on this channel about the dangers the world is facing, trying to come to grips with the aftermath of the pandemic and the lockdowns, the difficulties associated with the supply shock and price illusion, not to mention still living in the shadow of the 2008 crisis. To put it mildly, there's a lot of systemic uncertainty. Now, I've recommended gold as a store of value hedge for years. In fact, it's the ultimate error hedge. But if all you're doing is owning gold, you're only preserving your wealth, not growing it. And that's where today's video sponsor, Monetary Metals, comes in. With Monetary Metals, you can earn up to 4% in their leasing program immediately upon funding your account. And there are higher yields available to accredited investors in their bond offerings. The interest that you earn on your physical metal is paid in ounces of physical gold or silver, which you get in addition to any price appreciation from gold and silver while you hold them. So join the thousands of investors earning interest in physical gold and silver every month with Monetary Metals. There's a link in the description of this video that has all the information that you need. We thank Monetary Metals for their sponsorship, and now back to the rest of this video. So where we were in the middle of February, as I pointed out a month ago in a video back then, something like the Bank of America Master 2 index of high-yield junk bonds, the spread there over U.S. Treasuries fell to 262 basis points at its lowest point last month. And the reason the spreads got that low is because the marketplace really fell in love with the artificial high in the economy that showed up around September and October, whether it was rate cut euphoria, the optimism around the presidential election, but most importantly, the increase in activity that was tied to tariff beating in the aftermath of the election. It looked like the economy was re-accelerating and reigniting after the summer recession scare last year. So credit spreads, which were low to begin with in 2024, as Deutsche Bank was pointing out, but from February onward, the recession scare, the growth scare first, and then now the recession scare began to really develop in the stock market, as well as any of the risky markets, including high-yield corporate credit. Since then, spreads have been moving higher. Got to as high as 340 basis points last week before backing off a little bit as the stock market and more risk markets were stabilizing after the pretty substantial sell-off. So as of yesterday, the Bank of America Merrill Lynch Master 2 was down to 318, so backed off from 340, but still quite a bit higher than it was at 262 in the low. So you're talking about an 80 basis point increase in spreads, which is not a catastrophic. It doesn't denote massive crisis, but it is a significant move. In fact, it is on par with what we saw last August. From July 29th of 2024, when the index spread was about 313 basis points, and it was up already from 305 on July 22nd, went from 313 on July 29th to 393 on August 5th. So basically in a week, it soared by 80 basis points. So that was more of a disorderly forced liquidation type of thing that had to deal with the yen carry trade and the investment of Japanese firms and risky CLOs and things like that. And then the spillovers into all these other markets that went along with it. This time around, we see less of a Japanese, not entirely Japanese free, not entirely yen carry trade free, but less of a Japanese pattern in it. But more importantly, this is not just a short, sharp, everybody run for the exits all at once. This has been building over several weeks, and it continues to go up. In fact, today stocks are selling off, and so is corporate credit. There's more behind this than there was last time in last August. It was more fleeting. It was more of a knee-jerk reaction to the deterioration in the labor market data. This one's more, there's more behind this one. There's a deeper concerns about this really being closer to the fundamental picture of a real traditional recession. The BBB rated index for high yield junk, that one hasn't moved all that much. It was down around, it was actually under 100 basis points in the middle of February, came back to 120 basis point spread. Now it's right around 116, though all these spreads are going to be higher today with the sell-off going on in risk assets, at least before I started recording here. But that sell-off hasn't really reached the higher quality credits yet. It's mostly the riskier asset classes, high-yield bonds and leveraged loans and some CLOs. Hasn't really got into the BBBs or the higher investment grade tiers just yet. And that's one of the things we're going to be looking for is this, if this continues to move forward. Do credit spreads make a new high? And if they do, does the sell-off and the repricing start to get into some of the some of the upper tiers of the credit markets. But so far, the triple B reaction has been muted to the recession and growth scare, which might just be a product of the fact that it's relatively new and it's really starting to be taken seriously for the first time, even more seriously than last August. Some of the riskier credit tiers, the highest risk, the triple Cs or the triple hooks, those really plunged. The spreads really plunged last year and into this year. The artificial high, the riskiest parts of the market were really taking that artificial high as if it was the soft landing being confirmed. So you saw the triple hooks get down to 706 basis points as a spread. Since the middle of February, that backed up all the way to 872 basis points, and it's come back a little bit since then. So you're talking about 160 some odd basis points in. Once more, it was on par with what happened last August. The triple hooks were right around 919 basis points in spread. So you can see already just how low spreads have gotten to be in 2025, even compared to last summer. So you still have, even the triple hooks that made a big move similar to what we saw in August, but it's not the market melting down. It's the market acting even more seriously on the idea that the recession scare isn't going away. That's really the important point here is the markets are taking this recession scare, not just as a one-off, but it's there and then it's there and then it's there and it's continuing to be there. So the fact that it isn't going away is far more important. And the fact that credit spreads have moved as far here in February and March as they did last August is even more important too. But it's not just high yield junk bonds. We're seeing this repricing of risk go on in other parts of the marketplace too. Leveraged loans, CLOs, even private equity. Algebris Investments portfolio manager Gabrielle Foa warned in February that high-yield credit default swaps, which protect against defaults, were trading at levels that had only been seen 3 times in the last 10 years, and each time it was followed by a sharp widening in the 6 to 9 months afterward, talking about spreads. Fast forward to now, and the market CDX North American High Yield Index, which falls when credit risk rises, has dropped to the lowest since last August. And that's not all. Private credit, the same article points out, at a conference in London this past week, a number of attendees spoke on the sidelines of concerns about interest coverage ratios at private equity-owned companies and the risk that their firms are holding too much leverage and the need for direct lenders to diversify away from a possible overexposure to corporate credit. And why is it the corporate credit space overexposed? Because everybody was in on the soft landing. If you think there's going to be a soft landing, there's no risk to these company issuers. Therefore, buy the riskier asset. Reach for yield. It makes sense. Reach for a little more yield. As long as GDP is positive and the payrolls look good, reach for more yield. Even if you don't get a whole lot of additional yield, if you're convinced of the soft landing, there really isn't any extra risk. So even though you're not getting compensated for more risk, you convince yourself there is no risk. So you take the extra return, what little it is, and put it in your pocket. But a big one too, leveraged loans. A fall off in mergers and acquisitions was a plus for issuers in the leveraged loan market over the past year as yield-hungry investors snapped up any deals that came to market, many of which were repricings. Money managers are now becoming more selective, pushing back on aggressive pricing and credits with lower ratings, with 5 deals pulled from syndication in recent weeks. So even in the leveraged loan market, there's the same sort of taking a step back, initially reassessing what's really happening. Are we headed for a soft landing? Is the risk of a recession rising? Is it serious? And the market is coming back with being unable to answer those questions as a no. They keep saying, we want to believe in the soft landing. We want to believe this is nothing more than a growth scare. But then we keep getting incoming macroeconomic data like retail sales yesterday that suggests the entire narrative behind the soft landing is under threat. Think about it this way. Mainstream economists in these markets have been thinking about the economy holding up largely because of consumers that continue to spend in the face of serious headwinds. So the argument was, if consumers are spending in the face of serious headwinds, they must be strong and resilient, when that was the wrong way to look at it. What really was happening is that consumer spending was holding up despite of, or in spite of, all of these headwinds that were hitting consumers. And if they went on longer, and if they got to be even more severe, then there was a serious threat to consumer spending, which is what was big about retail sales yesterday, suggesting that those headwinds are indeed finally impacting consumers. And if they are impacting consumers, they impact a whole lot more than that. They impact the very idea of a soft landing. Suddenly, the traditional recession chances go way up because of a misreading about the strength of the consumer economy. And the repricing of credit and junk bonds, there's a lot more systemic issues there than it might seem otherwise. We went through this in 2019 with the oil price crash in late 2018, what we called the landmine here at Eurodollar University. That triggered a whole bunch of repricing in the same leverage loan risky credit, led to a lot of repricing in leverage loans, which then created knock-on consequences in repo markets as collateral, along with the questions in Eurobond markets and repricing there. Rising spread led to greater risk than just to those individual securities that were offered in these marketplaces. They actually created systemic difficulties that ultimately led to the repo rumble of September of 2019. There was also a yen connection, a Japanese connection in 2019 too, because Japanese firms were heavy buyers, reached for yield back then as well. And even the Bank of Japan had warned in late 2019, hey, be careful about CLOs and junk credit in a US recession scenario. And that's exactly what provoked the sharp response last August. And we're seeing a little bit of the same thing here in Japan. It's not front and center like it was last August. It was the carry trade reverse, which provoked the decline in credit, the sharp rise in credit spreads, the decline in credit prices, and therefore the decline in stock markets as a spillover in the VAR shock. The yen carry trade participants were the reason for the August backlash, whereas this time it's much closer to home, with any yen carry traders that are getting caught up in it sort of just along for the ride. Though we do see a couple things. For example, the Japanese yen is much stronger against the US dollar. It was up as high as 147 to the dollar last week before backing off to 149. Though that's not quite as strong as you'd expect given interest rate differentials, which do matter for portfolio rebalancing in the short run. So there's more of an interest rate reason for yen strength than there is a carry trade. But the week before last, March 6th through 10th, you saw a pretty sharp rise in credit spreads in US dollar junk credit. At the same time, for example, the Japanese government bill rate, the 3-month bill rate, sank pretty sharply from 35 basis points down to 28 basis points, coincident to the sharp rise in yields, suggesting maybe a little bit of a carry trade reshuffle there. So while the Japanese are not at the forefront of this reversal in the credit markets, they're still there lingering in the background. In many ways, that's not good either, because that means if the Japanese decide all at once, like they did last August, to exit the space, it's only going to add more selling pressure, more of the crowd heading for the exits at the same time. At the same time, as that creates bigger problems and spreads, the exits get narrower and narrower and narrower. Liquidity becomes less and less and less. It leads to distressed sales and fire sales and all the sorts of systemic repo problems and monetary problems that we've seen too many times over the last 20 years. But we aren't there yet. Credit spreads are coming off their ridiculous lows. The bad part about that is when they get to be that low, it's usually before something bad begins to happen. But we aren't there yet. As it stands, so far, the rise in credit spreads has been relatively orderly, happening over a couple weeks rather than a couple days as they were last August. But in many ways, that's not necessarily better. That might mean that the market is taking the recession scare or the probability of the traditional recession that much more seriously than it did last August. All of these indications suggest that recession scare dynamics are going to continue to grow. So what we're watching here is to see how the credit markets, especially this part of the credit markets, responds to the recession scare not going away, not being answered and solved in a soft landing confirmation. As spreads continue to rise, are we going to see them become a little bit more disorderly? Are we going to see the sell-off in credit markets spread to other parts of the credit markets, into the triple Bs and into the upper tiers of the credit markets? Are we going to see leverage loan prices continue to fall more sharply? Private credit, are deals going to be pulled like they have been in Europe? We're going to see this type of problem, this recession scare, go across the currency denominations and infect other places around the world, other geographies. Are we going to see the credit problem that's developing here under these spreads? Is it going to spread into all these other places? That's what we're watching next, because everything demands that we take this seriously, up to including the sell-off in the stock market. As I said last year, the markets have to reprice risk, and that's exactly what they're doing right now, and they're doing it in a way that's even more serious than last summer, because at the end of the day, The cycle was still a cycle, and we're further along in it, which means we're getting closer and closer to that part where the markets have to adjust to being wrong about the macroeconomic climate. As I mentioned, retail sales, that's a big one because the US consumer economy has been a huge part of the soft landing story. Went over the retail sales details in the link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and Eurodollar University subscribers. And until next time, take care.